Good morning, everyone. I've got a few slides on economics and the backdrop because obviously it is extremely important. But I'm going to rattle through those and then spend more time on the portfolio, what we're doing, and how we're thinking. But first of all, just we like to show this chart, and admittedly it does go up to April. So if you looked at May, it would look a little bit different. But the yellow line, the FTSE 250 ex-investment trusts. Everyone talks about the S&P and look at these returns, and we didn't pick the starting point, by the way. So just, there's always a reason why you should be looking at mid and small caps within the UK, and this chart proves it. You're going to hear quite a lot, I think, this morning from others, again, about relative equity valuations, and the discount within the UK is... I was asked literally just before we started, did I think the UK was on something like a 40% discount? And the answer was yes. Actually, this suggests even more, even against Europe. So I have also been told on a couple of occasions, please don't just talk to me about valuations and how cheap the UK is, because what's going to be the catalyst and everything. And I said, as an investor, what you're always looking for is cheap valuations. Buy cheap, sell high. Turning to the economic outlook, obviously we look at a whole lot of factors, but this one, these charts, very, very important to us. I'm not here to tell you, I don't think it's going to surprise you, that the UK is in a great place. That's not the issue. The issue is, is it in a terrible place? Is it getting worse? And is that in the valuations? So. If we start bottom left, inflation, very clearly we had an absolutely drastic problem over the last couple of years. Yes, we've had a little blip, but if you look at the Bank of England minutes and general forecast, we're going to be knocking on that 2% number. We don't see anything like a rise above the kind of 4-5 number that we've seen in the recent past, and therefore we are in the camp that we believe we're definitely going to see more interest rate cuts this year and probably next too. We still believe equilibrium for interest rates is a lot lower than current rates are set at. And that is extremely positive for UK in general, but UK mid and small caps, and there's many charts you can look at to show that correlation. UK consumer confidence, so it's something that we really focused on. In general, you can see we're a gloomy lot, go back to 2016, so guess what, Brexit. And you can see headline consumer confidence has been negative, but during that time we've carried on spending, very importantly, because we're a consumer-driven economy, and there has been a small uptick. Very clearly, the whole April tariff tantrums, etc., etc. I think they're not the whole world, and they're definitely not consumer confidence. But this is something we're following very, very closely because we think it's going to continue to tick better. Household savings ratio are unusually high in the UK. So what we need is consumer confidence to get stronger for people to stop saving as much and start spending. And then the UK PMIs. So when I said, clearly I'm not here to tell you it's all great, but actually it's not that bad either. And the UK composite PMIs would very much suggest that's the case. We did again see a little negative blip. So remember, 50 is neutral, above 50 is purchasing plans, and below that suggests decline. And again, April. Unsurprisingly, with the tariffs, and of course with the rise in national insurance for UK companies. Had an impact on PMI numbers, but again, we're waiting to see if we're right, but we think that was probably a blip caused by those two factors. I'm going to rattle through the next couple of slides, but again, here you are, UK accumulated excess savings, very, very positive. We always have been a nation of shoppers. Please, let's go shopping again. And then over on the right, again, this may surprise some of you, economic indicators, it's all about expectations, and expectations are so low in the UK. As you can see, economic indicators are coming in above that in general. M&A. I wouldn't be able to talk about small caps at the moment without talking about M&A. It has been such a feature really for the last year and a half now. And so the numbers may not look that great. UK obviously is the one in the turquoise, but that's because there's a lot of small caps that are being taken out at the moment. So, cumulatively, they have to add up quite a bit to be a percentage of market cap. But literally, it's hard to think of a week, honestly, a week that hasn't gone by this year, ignoring, again, the tariffs of April, when we haven't seen a bid. Or story of a bid appears, disappears, whatever. But there is so much interest in our area of the market because of valuations. Buyers are not buying for the next 3 or 6 months; they're buying for the next 15, 30 years, and it's showing. I will just say on this, we've had some bids. We've had some very nice bids. We've had some interesting conversations with our investment companies. So I have actually gone out of my way with certain of our companies to, in discussion with the chief executives, to let them know our views on any potential bid. And really, truly, I've had conversations with quite a few of the CEOs where I have let it be known that, in my view, one shareholder, sometimes a major shareholder, but only one shareholder, so I said, please talk around. If a bid came along that wasn't a minimum of 100% premium, I didn't want them to even start having those conversations. That may sound ridiculous, but that, in our view, is how ridiculously cheap a lot of our companies are. And you can see it in some of the bid premiums that have come through. So, yeah, as I say, when we talk about undervalued, we really, really believe it. I tell you what, in the interest of time, I'm going to skip through this, but again, yeah, why are we so cheap? Well, lots of reasons, but a very, very, very large part has been the massive move away from equities in general, especially from pension funds, and of course the move to mainly the US market, people putting their investments into the US. So turning now to our investment trust. So just to very briefly, this actually, so it used to be called JPMorgan Smaller Companies Investment Trust, and then we merged it with the mid-cap fund that myself and Katan, my colleague, that we also ran, and changed the name. This was all, 15 months ago now. And what we also did at the time was change the name to JPMorgan UK Small Cap Growth and Income, and we have a set income policy, which we'll come to. So what do we do and how do we do it? We have an investment philosophy here at JPMorgan Asset Management. And when I read it out loud, it's so patently obvious. But what we're looking for is attractively valued, high-quality stocks with positive momentum. We measure this. We measure this on a portfolio basis and on every single stock basis, stocks we own and stocks we don't. We have screens that are updated every day on this. First and foremost, I keep talking about that for the UK. It's very, very true for our area of the market is value. When we talk about value, the metrics we use are the humble PE, but absolutely crucially, we use free cash flow yield. And as you can see, our index is on a 5.7% free cash flow yield. And that is a historic free cash flow yield. So those numbers will be growing, not declining. And our investment trust is on almost 8.5% free cash flow, 8.5% historic free cash flow yield. It's so cheap. I literally can't find the words to describe it. Value, extremely important. Quality, absolutely essential. And we look at a whole lot of things. We look at return of capital allocation, which is becoming a major issue with such cash-generative companies and such strong free cash flow yields. One of the areas we focus on is ROIC, and as you can see, the index has a really pretty acceptable ROIC of 9%. The trust is knocking on 15%. So, and that's this number hardly moves for us. It's absolutely a given within our portfolio. And then thirdly, so VQM, momentum. And when we're talking about momentum, we are partly talking about price momentum, but very largely the huge focus for us is on earnings momentum. is a company hitting its numbers. And as you can see, we've got a small positive tilt versus the index negative. We think there is a huge amount of information about in upgrades coming through in the market, and as I say, it's a very key focus for us. So if I turn now, just a fun summary. So as I said, well, I think I said our new mid smaller companies plus AIM ex-investment trust is our index, which goes up to circa 1.6, 1.7 billion. We'll go all the way down to circa 100 million is our remit. We have gearing. We like gearing. And we are circa 10% today, which is a fairly normal number for us. We can go higher, but we don't like it to be the tail that wags the dog, especially in these volatile times. And we can definitely go lower. And normally you'll see us go lower because we've been selling things and we've had a bid, etc. I touched on the dividend policy. So when we did the merger, we put in place an enhanced dividend policy. So our year end is the 31st of July. At the 31st of July, we take the NAV, a factual figure, and we commit to pay 1% quarterly of that NAV, of that July number, as dividend. So actually, as we speak today, the actual yield is just over 4%. Looking to the right, annualized performance. So why, if you're interested in the UK and you're interested in the market, why should you be interested in us, in the JPMorgan UK Small Cap Growth and Income Investment Trust? So as you can see, I should say I've actually been running this fund for unbelievable amount of years, actually 25 years. So 10 years is sort of drop in the ocean for me. But here's the 10-year excess returns per annum, extremely strong. Ditto, obviously, the 5 years. We've had a very good 3 years. But 1 year, I mean, we were ahead of benchmark. We are ahead of benchmark as at end of April, only just. And so for us, this would be pretty disappointing. But as you can see, quartile rankings, it's been extremely difficult and volatile in our end of the market. And, so that, to be honest, not very impressive outperformance over the 1 year still puts us first quartile, and we're first quartile over all periods. So when I talk about volatility, so it's just to see how you get to those numbers and that returns. You can see some of the large holdings within the portfolio. So, there've been several stocks that have done 40 or 50% over the last year, and you can see a flavour of them. I'm happy to take questions on anything. You can also see why, when it goes wrong, it goes horribly wrong. Over on the left, one we didn't own, have never owned, is John Wood, down almost 90% on the year. Over on the right, so we didn't have, as I said, we didn't have the strongest performance in the year, but we were ahead of benchmark, and you can see some of it again when I talk about volatility in the share prices. One or two of these are extraordinary because really, the company's done nothing wrong. In our view, by wrong I mean has it had a profit warning? You'd expect if a share's down 20%, or indeed a very large holding for us, Ashtead Technology, down 40%. So you're like, well, why do you still own it? When was the profit warning? And we say there hasn't been a profit warning. It hasn't put a foot wrong, and the stock has derated by 40%. So guess what? We still own it. Next 15 did. We do now. We do still own it in a very small way because it's unbelievably cheap. But that had a massive disappointment, winding up with a very large contract. A couple of things that we missed. So Keyword Studios. So that stock return. So when I talked about 100% premium on bid, Keyword Studios, which we sadly didn't own, was bid for, had a very, very healthy premium. Again, happy to take questions on any of these as and when. So we're just giving you a few examples here of sort of additions and exits in the portfolio. If I just touch on a couple, so Ergomed, I mean, we should probably update this slide because Ergomed was a little while ago now because that was actually a takeout, so that was absolutely excellent. National Express, now called Mobico, we saw this quite a long time ago now, and Videndum, both of these were on balance sheet question marks, very large question marks for us. You know, I talked about free cash flow. We really focused on free cash flow yield, but guess what? You know, we also very much focused on balance sheet, and we became uncomfortable with both of these inequities. And workspace, I think, in general, you know, it's you're about to hear from British Land, but you know, it's quite tough out there for real estate companies, and we just had better ideas to put into the portfolio. So if I touch on, well, just two. So Hostelworld, which basically is, in our view, it's a tech company, which basically is a social media platform for booking hostels and connecting up with others in the world of backpacking, really. And so in our view, it's a tech company, and it's on circa 10 times PE. It's again, when I talk about utterly mispriced, this one would definitely come to mind. And then IPOs, I've talked about M&A, IPOs, there have been very, very few, but Applied Nutrition was one that came a little while ago now. Share price has not done so much yet, company not put a foot wrong. We have very high hopes of this. But our view and our take on IPOs, we try and see almost all of them, as long as they're profitable companies with the right kind of market cap for us. And you know, so we do the work regardless, because if it's going to come into our universe, we always want to know about the companies, whether or not we're going to invest. And then Applied Nutrition would be a good example. We will start small, and if the company proves itself and starts to perform in the way that we're expecting it to, we will add to it, you know, as the share price goes higher. That's how we work. And if it doesn't go right, we cut and run very swiftly indeed. Looking now, we are much more focused on the stocks than sectors. This is an outcome for us. You know, of course, we look at it, we check on it, make sure we understand the bets and the tilts we're taking within the portfolios. But as I say, nothing should be read as this, because it's made up of individual stocks always. And as of a month ago, how are we positioned? So you can see we go for some pretty chunky in our top 10. Our maximum relative position, our maximum active position is 5%. So you know, we can have almost 6% of the fund within one name. Above that number, we will always be trimming, or always be looking very carefully. Obviously, I like this list. I think it's full of extremely exciting and generally very strong growth companies. But it's also a mixture, as it should be. You know, we don't want it all in one sector. We don't want to be playing one theme. This is, you know, we have an enormous universe within our Numis index, and you know, we are very much spoiled for choice. Turning now, just I showed you the quartile rankings, but here, as I say, I've been running the fund all this time. Catan joined me in, I'm going to say, 2012. So he's been over a decade with me on this investment trust, and here is our long-term performance. And with that, I'm going to leave it. I hope I've made some I hope I've been clear in the messaging, and please ask me any questions.
Georgina, thank you very much indeed. Absolutely fascinating. And the small cap environment is one I know that a lot of people are interested in. We've got lots of questions coming through. I want to pick up on that point, if I can, first of all, about the cheap valuations. And there have been a number of nods towards this in terms of some of the questions. What measures are you taking to manage the discount that is being applied to many of your holdings at the moment?
Okay, so that's a question not about our investment trust, but about the holdings.
Right.
That's actually quite an unusual question, because share prices aren't in our remit. You know, no. What we do is what we actually, and definitely where we own companies and the share prices, you know, go down. Again, this is about for no reason rather than when there's an issue. Guess what? We buy more. And I can give you one very nice example of this. It's not a huge, sadly, it's not a huge position for us within the portfolio, but we own, and we've owned for some time now, a very small cap called Renault. And this is a profitable growth company. Chief exec's been there did a turnaround, but I mean, he's been there 10 years or something. We've been following it. We followed everything, for a long time before we bought into it. It had a massive pension issue, which has been diminishing over time. So that was, for us, that was the catalyst when we got in. And still the stock, and I'm not making this up, the stock was on 5 times PE. This is a profitable company, growing nicely. And I just kept looking at this, like, in no world is 5 times PE. 5 times PE, it says you're distressed, you're probably going bust. There's such strong message. Guess what? One day it was down at sort of 4.5 times PE, and I was like, I can't bear this. We're buying more, so we bought more. That company, a small cap, announced in the last couple of weeks it's had 2 individual approaches, and sadly someone's going to buy it. I hope they buy it at the right price, but obviously I have no idea. I'm suggesting that it will go out, and you can imagine if it's on 5 times PE, imagine the type of premium that we'd be expecting.
A couple of comments about companies that have had big declines. I think I saw MJ Gleeson, the house builder, on your list. Turn your nose about that. Have you been adding to MJ Gleeson following the recent falls? Another mention about HVivo, all these small cap companies that have been seeing some recent declines. How do you filter out the opportunities to buy more or get into stocks that you aren't into because of these declines that you're looking at? What's your attitude towards these steep declines in some of the stocks we've seen?
Well, it's a great question, and yes, you just picked on. We're having quite a good year, but 2 very recent, and I'm going to call them disasters within the portfolio. They are disasters, down 50%, one of them on the day. Yes, it's had a little bounce. So the huge advantage that we have is, as shareholders, is that we get to talk to management. So guess what? Obviously management puts out a statement, you read all the analysts, you read their statements, you read the analyst research, you try and work out what that's going on. But then we get to drill with management on that. So, which will obviously have an effect on our views. If I just say so where we sit on HVivo at the moment, we guess what? The position is smaller, is a lot smaller than it was. It's getting to be really quite small in terms of size, and that matters to us because you have to always worry about liquidity. So I think our view is this is extraneous. The company, as a company, yes, it's had a massive profit warning, absolutely no question, but it wasn't brought on by their own fault. It wasn't brought on by mismanagement. This is the environment with what's going on in the US in terms of pharmacy and the pharmaceutical industry, and in terms of biotechs trying to raise money and funding and everything. So we're annoyed with ourselves that we hadn't reduced it beforehand because these were known risks, but they had a very nice order book. Guess what? They lost a very big contract, which so the order book disappeared. But we interesting, and most crucially of all, when your company has that kind of profit warning and goes into loss, our first question is remind ourselves of the balance sheet. Balance sheet's absolutely fine. It's got cash on the balance sheet. Absolutely, there's no issue there, and that matters a lot to us. Gleeson was a much bigger disappointment because all the other house builders have said pretty much the opposite. I mean, in no way. All the others have been really getting more positive, as have we. And Gleeson was a real shock to us because in our view, for those who don't know, it really focuses on the very, very bottom end of the new housing market. So one of their strap lines is that 2 people on minimum wage can a couple on minimum, both on minimum wage, can buy one of our properties, and they'll be paying less than they would in rent. So given that huge hikes in minimum wage, we thought this was going to be set there. So that one, this was only literally came out yesterday. So I think you could say we're still sort of working through all the numbers on that one. But yeah, bad things happen. It's a good
Indeed, yeah. Let's pick up another point. You mentioned the amount of mergers and acquisitions. There seems, though, to be far fewer IPOs these days. This is something we've been talking a lot about in these conferences. There are far fewer companies coming in at the bottom. The question is, could this be an issue for a trust dealing with small cap companies?
Okay, great question. So as I showed you, one of the fairly new inputs into the portfolio was a really nice, sensible, we think great company, Applied Nutrition. But as you say, there's been such a dearth. The good news is, and I have to be careful because I've called Dawn several times too early over the last couple of years, but for investment managers like us, we get we get offered a lot of what they call early looks. So these are companies who are definitely thinking in the near term about floating. You don't do this a couple of years in advance. And they come and see investment managers like myself and Catan, and we give them feedback, and then they decide how much interest is likely to be, and then they do or don't go ahead. And my diary is starting to fill up again with early looks. So as I say, I don't want to suggest that the issue is over, but there definitely are still companies looking to come to the UK stock market. And then the other point, we're asked often about this. So as I say, our benchmark, the new mid smaller companies plus same. I actually can't remember the number because a lot of them are far too small, right at the bottom end. We've got 600, 700 universe of stocks. One thing we don't have is a lack of choice. So fantastic if we're in the past, Catan and I have proven we like IPOs. We've been generally, of course we make mistakes, but we've been generally successful to extremely successful in buying the right IPOs, and then we can own them for a decade afterwards, if they're doing all the right things. And Ashtead Technology, when I showed you where the share price is obviously fallen significantly over the last year, but we bought that at float. We've still made a lot of money for our investors in that.
Yep. Time for just one more question. It's something I really want to approach all three guests on this morning, is the wider economic cycle and the threats from excessive public indebtedness, slowing growth. We heard recently that, in fact, the Bank of England might not be too encouraged to drop interest rates, maybe not as fast as you had hoped. We heard some recent comments coming through from the Bank of England governor. The OECD has declined or has dropped the overall growth prospects of the UK economy. We've got lots of political problems for small caps, this IHT business, big question marks about whether or not that's going to be allowed to continue, something you've got to be able to move into small caps to get IHT benefits and so forth. There's a lot going on in the background space. Just a quick thought on bringing all those points together, if you can.
Well, what do I say? There's so much going on. Of course, we think about all of this, and it's absolutely the backdrop to everything we do. But I would say, first and foremost, and this is the beauty, in particular, being a small cap fund manager, that is the background and the backdrop. Our companies, if we choose the right ones, can do absolutely good to great despite the circumstances. And I say this having been an investor, during the global global financial crisis, the GFC, if you remember that, I had companies that continued to grow all throughout that period. Remember, these are small companies, so growth is in their own control. It doesn't matter what GDP is doing. GDP is less important down in this area of the market. So kind of start with that, and then again, I think I'm going to repeat myself. Going to go full circle and touch on valuation again, because the whole question is how much of this is in valuations. And we've seen the discounts. We've seen discounts to Europe, let alone the US. I think a lot of this, if not all of it, if not more than all of it, is in the price.